versus independent contractor, tax issue of employee stock option, IRA or Roth IRA, which is better? Now talk about the employee versus independent contractor. Compensation from both the employees and the employer's perspective. It includes the basic information necessary to design a compensation package that offered tax saving to both. Employees can significantly increase the after-tax value of compensation by taking some of their compensation as tax-exempt fringe benefits. The cost of tax-exempt fringe benefits is deductible by the employer, even though the value of such benefits is not taxable income to the employee, providing a win-win situation for both employer and employee. To prevent abuse, however, most of the tax-free benefits have significant limitations. An awareness of these limitations is important to maximize the tax saving that can be achieved through the best use of these tax-free fringe benefits. Stock and stock options are popular compensation tools and are used as incentives to both recruit and retain employees while requiring no cash outlay by the employer. Stock options offer employees an opportunity to acquire stock at a bargain price and can provide the dual tax advantage of deferring income to the future year and converting what would otherwise be ordinarily compensation income into long-term capital gains tax at favorable rates. What is self-employed tax? Self-employment tax is a tax consists of Social Security and Medicare tax primarily for individuals who work for themselves. It is similar to the Social Security and Medicare tax withheld from the pay of most wage earners. Independent contractor defined people such as doctors, dentists, veterinarians, lawyers, accountants, contractors, subcontractors, public stenographers, or auctioneers who are in an independent trade, business, or profession in which they offer their services to the general public are generally independent contractors. However, whether these people are independent contractors or employee depends on the fact in each case. The general rule is that an individual is an independent contractor if the payer has the right to control or direct only the result of the work and not what will be done and how it will be done. The earnings of the person who is working as an independent contractor are subject to self-employed. Employee versus independent contract. Working individuals are either self-employed or employees. Self-employed individuals include partners, sole properties, and an independent contractor is a worker who is subject to the direction of another only as to the result of the work accomplished, not the means to accomplish it. Most consultants are independent contractors. The determination of employee or self-employed status is a very controversial area. Business try to increase the use of self-employed individual to eliminate FUTA taxes and to exclude them from most employee fringe benefits programs. Workers who incur significant unreimbursed business expenses have an incentive to be treated as independent contract rather than employees because they deduct their business expenses directly from their gross self-employment income. As employees, they would pay FICA taxes on their gross earnings, and their reimbursement business expenses might be of only limited benefit as miscellaneous itemized deduction. An employer may attempt to avoid paying employment tax and providing the fringe benefits for persons who perform work for them by deliberately misclassifying the workers as independent contractors instead of employees. A person who is anxious to be employed may be willing to accept independent contract status simply to obtain the work. The IRS is aware of this and has audited business looking for such misclassifications, building business for back tax and penalties. Conclusion: although independent contracts make money more than the employee compensation, but overall, the employee's salary plus all fringe benefits, the total earning more than independent contractor. Contractors need to use a lot of time to figure out how to pay tax, insurance, benefits, etc. But the employee only rely on the company to calculate for them. As a result, the employee save a lot of energy and time. So the answer is employee better than the contractor. The number 2, tax issues of employee stock options. Corporate stock option is a right to purchase the corporation's stock for the state's price for the specified period of time. The grant date is the date of which two options is first offered to the individual. An employee exercises an option when he or she purchases the stock from the company. The employee benefits from an option if the stock appreciates in value between the grant date and the exercise date because the strike price is fixed. The employee usually recognizes no income when the option is granted. Instead, income is deferred to a future year when the option is exercised or the stock is sold. Options provide employees another opportunity to have an investment in their employer company without requiring an immediate cash outlay. Unlike actual stock ownership, if the value of the stock declines, the employee does not suffer a direct loss, as the employee can simply allow the option to lapse. Employees also like the inherent leverage in options because the increase in the value of the option is proportionately greater than the increase in the value of the company stocks. Employees favor stock options because they require no cash outlay by the employer when they are granted and can result in cash inflow for the employer when the employee exercises the options. employees also receive a tax benefits from the compensation deducted equal to employers' compensation income in the year the income is recognized. Conclusion: stock options for employer and employee both are win. The third question: IRA or Roth IRA, which is better? IRA, individual retirement account. An individual retirement account is a personal retirement plan available to anyone with earned income during the year. Roth IRA. An individual may take a non-deductible contribution per year to Roth IRA. So, my conclusion is Roth IRA contribution interests are tax-free when withdrawn after age 59.5 or up. Earning and contribution to traditional IRA will be taxed when withdrawn after 59.5 or over. So, Roth IRA is better. Thank you. Take a look at my tube. Have a good day. Bye-bye.